You ever stare at a chart, thinking, okay, this looks bullish, I think, only to enter a trade and get stopped out almost instantly? It's frustrating, right? The problem isn't your indicator, and it's not that the market hates you. The real issue is you're trading without a map. See, most day traders skip the first and most important step, understanding market structure. Without it, you're guessing. With it, you're predicting with confidence. And in this video, I'll not only explain what market structure is, I'll give you a short, practical example in each section so you can see exactly how it works in real trades. Today, I'm going to break down how market structure gives you context, the kind of context that separates the traders who win consistently from the ones who are always chasing the next perfect setup. If you're serious about improving your trading game, keep watching until the end, because I'll show you with real charts how to identify market structure and how to trade it like a pro. Hit that like button right now and subscribe, because you're about to see the market in a way most traders never do. Section 1. Why market structure is the trader's map. Imagine you're dropped into the center of a massive, unfamiliar city. You can see skyscrapers, busy streets, flashing lights, but you have no idea where anything leads. Without a map, you might wander into a dead-end alley or circle the same block for hours. That's exactly how most new traders operate. They see price moving, they see candles forming, but they have no sense of direction. Market structure is your navigation system. It doesn't just tell you where price is right now. It gives you a clear picture of where price has been, where it's likely to go, and the path it might take to get there. For day traders, that navigation comes from understanding how highs and lows are forming. Higher highs and higher lows equals uptrend. Buyers are in control. Lower highs and lower lows equals downtrend. Sellers are in control. Overlapping price levels equals range-bound market. Neither side is winning, and price is coiling before breakout. Example, let's say you're watching NASDAQ on the 5-minute chart. Price has been printing higher highs and higher lows for the past hour. Even if you see a sudden bearish candle, market structure tells you the buyers are still in control. That context keeps you from panicking and selling into a healthy pullback. Section 2. The context market structure gives you. Market structure is more than just trend spotting. It's about understanding who has control and where that control might shift. Think about it. Every candle, every push, every retracement is the result of a battle between buyers and sellers. Structure tells you which side is winning, where the front lines are, and where the next fight is likely to take place. That context lets you identify key reaction zones, support, resistance, supply, and demand. Spot breaks in structure that signal momentum shifts. Avoid trading into areas where the market is likely to trap you. Example, you retrading NASDAQ NQ future contract. Price has been forming lower highs and lower lows for most of the London session. Suddenly, it breaks above the last lower high. That's your first clue. Sellers may be losing control. A retest of that breakout level gives you a safer, more informed long entry, instead of chasing price when it's already extended. Section 3. Avoiding the rookie mistake. New traders often fall into the trap of zooming in too much. They get fixated on a single candlestick or an indicator flashing buy or sell without realizing that signal is forming in the wrong part of the market story. It's like trying to swim upstream in a fast river. You can fight as hard as you want, but the current is stronger. Market structure forces you to zoom out. Before asking, should I buy, you ask, what's the current trend? Where are we in that trend? The beginning, the middle, or the exhaustion phase? Are we near a key level that might flip the market in the other direction? Example, you spot a bullish engulfing candle on Tesla's 1-minute chart and think, perfect long entry. But if you zoom out to the 15-minute, you see Tesla is in a strong downtrend, and that candle formed right under a major resistance level. By skipping the zoom out, you would have bought into an area where sellers were waiting to hit hard. Section 4. How to identify market structure. All right, traders, the time has come to finally deliver on the promise. As a beginner, I know how overwhelming trading can feel. Charts look confusing, strategies seem complicated, and it's easy to get frustrated and even consider giving up. But here's the truth. Identifying market structure doesn't need to be complicated. In fact, simplicity is your greatest advantage. That's why I've broken this down into 6 evergreen steps, a framework you can use again and again to read the market with confidence. No fancy indicators, no unnecessary complexity, just a clear and practical approach to understanding where price is and where it might go next. So let's dive into the 6 steps to identifying market structure. Step 1. Identify the overall trend. First, zoom out and ask, is the market trending up, trending down, or moving sideways? An uptrend forms when price creates higher highs and higher lows. A downtrend is the opposite, lower highs and lower lows. If price is just bouncing in a range, that's consolidation data. This gives you the big picture direction, your map before making any trading decision. Step 2. Mark key swing highs and lows. Next, identify the major swing points. These are the turning points where price stops moving in one direction and reverses data. Marking these highs and lows helps you understand the structure the market is building. Think of them as the skeleton of the chart, the foundation everything else rests on. Step 3. Define breaks of structure, BOS. When price breaks above a previous swing high in an uptrend, that confirms strength in buyers. When it breaks below a swing low in a downtrend, that confirms strength in sellers. These breaks of structure are key signals that control is staying with the dominant side, buyers or sellers. Step 4. Spot shifts in market structure, SMS. Sometimes the market flips. When an uptrend fails to make a new higher high and instead drops below the last higher low, that's a shift in market structure. It signals a potential trend reversal, the first clue that buyers may be losing control and sellers are stepping in, or vice versa. Step 5. Identify supply and demand zones. Now, look at the areas where price reacted strongly in the past. These are your supply, resistance, and demand support zones. Institutions often leave their footprints here, and price tends to revisit these zones before continuing in its chosen direction. Recognizing these areas helps you anticipate where reactions are likely to happen again. Step 6. Combine context with entry triggers. Finally, once you know the structure, don't rush. Use it as your context, then wait for clear entry triggers, like retests of broken structure, liquidity grabs, or rejection candles inside supply and demand zones. This step makes sure you're not just guessing, but trading with structure and logic. Section 5. How to trade market structure like a pro. So now you know how to identify market structure, but knowledge alone doesn't make you profitable. The real question is, how do you actually trade it like a pro? Here's the good news. You don't need to chase every candle or load your charts with indicators. Professional traders keep it simple. They use structure as a roadmap, then patiently wait for the market to come to them. Let me show you exactly how. To trade market structure like a pro, always align your trades with the dominant trend, seeking longs and uptrends and shorts and downtrends, and wait for price to retrace into key supply or demand zones rather than chasing moves. Enter only when you see clear confirmation signals, such as rejection candles or liquidity sweeps, while managing risk meticulously with well-placed stops and limited exposure per trade. Use multiple time frames to gain context. Higher time frames for direction, lower time frames for precise entries. And remember that trading less often but with higher quality setups is far more effective than overtrading. By following structure, patience, and disciplined execution, you turn your map into actionable, consistent profits. So here's the challenge for you. The next time you open your chart, don't touch your indicators. Don't even think about entry signals. First, read the market structure. Ask yourself, who's in control? Where are we in the story? And where is the next high probability move likely to happen? That one habit can transform your trading forever. If this video gave you that light bulb moment, smash the like button so YouTube shares it with more traders. Subscribe for more content that cuts through the noise, and drop a comment if you want me to break down specific market structure patterns in a future video. Trade smart. Trade with context. I'll see you in the next one.